Now for a deeper dive on today's bank earnings and what they mean for investors, let's welcome in Dave Ellison, Hennessy Funds portfolio manager. Dave, it is great to see you here today and help us kind of make sense of these bank earnings. You know, so you've had a few hours here, kind of make sense of the reports, Dave. I'm interested kind of what your big takeaway is. Did the core fundamentals you saw today, Dave, did they basically kind of track what you expected?
I think pretty much, yeah. There's really been no surprises, which is probably a good thing because usually in banks, the surprises are negative, which we saw, last March. So I think generally they're in line. I think everybody's looking for some special thing, but it's not there. I think the industry's battling through a big rise in rates the last 2 years, a big shift in the yield curve from positive to negative. Obviously, there's issues with commercial real estate office, regulatory changes, which usually are negative for them long term, additional capital requirements, and of course, the continued competition from private credit and other sources of capital that are making it hard for them to grow loans.
I want to ask you about Jamie Dimon's comments about some of the number points in JPMorgan's earnings and expenses. They have jumped 29% to $24.5 billion. So the banks have to spend more than analysts were expecting. Meanwhile, Jamie Dimon has been vocal about being concerned about inflation. Do these two things tie together? And what's the expense outlook for some of these big banks?
Well, I'm not, expenses are usually an offensive thing. So I don't think you cut yourself to, a high stock price. So I think generally the expenses are reflective of, obviously there's inflation in the industry and these guys have a lot of brick and mortar that they need to take care of. But there is a lot of expenses competing with the onslaught of technology and other areas that they're trying to compete against. So I think if you're trying to cut expenses, you better have a really good reason for it. If you're just cutting expenses to make the analysts happy, that's a mistake.
And Dave, let's just stick with JPMorgan there because interesting reversal in the stock today. We started off higher, Dave, now we're kind of modestly lower here in today's trade. 7 straight quarters, Dave, of record net interest income. JPMorgan was a winner in 2023. Do you still like it, Dave, here in 2024?
I do. I think I've been following banks since the early 80s. And in the early days, the small banks were the place to be because that's where the consolidation was. That's where the balance sheet repairs were happening. When there was a problem, there was a lot of problems. And then when they got better, you made money on the recovery. Now I think the bigger banks, you need to have bigger banks to be competitive in the market now. If you're going to grow loans, if you're going to be competitive on Wall Street, if you're going to have any ability to fight through a recession, you've got to be bigger. And I think the FANGs have told you that bigger is better. And I think we're moving into that area in the banking industry. So we need to have bigger banks to deal with not only the debt that we have now, but the debt that we're going to have not only in state and federal, but general debt that we're going to have in the system. And so I think bigger is better. That's where the valuations are going to come from, and that's where the stability and the growth is going to come from.
So with those bigger banks, part of that equation would be more assets, more loan growth. We're seeing that just maybe okay right now. Do you think that has to increase? And then how does that couple with charge-offs and delinquencies that we're seeing rising?
Well, I think charge-offs and delinquencies, start with that first. I think that hits everybody. There's nothing special about the bank's loans versus all of the other private debt or the private equity or, hedge funds or whatever that are out there that have made debt loans. So I think that affects everybody, and it's an economic issue. The issue is whether you're taking share. The banks have lost share through regulatory controls, capital needs, the unwillingness to take a lot of risk because of risk-weighted capital requirements. And I think they need to reverse that in some way. But again, you're not going to do that as a small bank. You're going to do that as a bigger bank. And I think longer-term loan growth is going to be a problem. But again, the bigger you are, it's going to be easier to solve. So we'll see what happens.
And Dave, another specific name I want to get your take on is Citi. Obviously, announced layoffs today. Not a big surprise there, but undergoing this sort of transformation under CEO Jane Frazier to get smaller, more streamlined. She actually said, Dave, the fourth quarter was disappointing in her words. 2024, she said, will be a turning point. What are your thoughts on Citi, Dave?
Well, Citi's, the stock's done nothing for 10 years. Luckily, I haven't owned it for 10 years, but I've owned it for 3 or 4 years. So, thanks to me, shareholders haven't benefited at all in my funds. But I think generally they have to do something. Hopefully, she'll start to do things that will rationalize what this bank is. It's hard to know what it is now. Hopefully, it will turn into something that has a purpose and a need in the system. And if it gets smaller, great. I think people say, look, it's trading at 60% of book, but what's book value? There's a lot of stuff that needs to be written down and rationalized. But I think longer term, it's one of the big 4, big 5 banks out there. It's needed, it's necessary, it has the size, and I think it'll be fine if she can execute on some of these things. So I think it's not a bad place to be.
And finally here, thinking about the Fed and interest rates and the structure of the yield curve right now, it's been inverted with short-term rates higher than long-term rates for roughly a year and a half, depending on how you measure it. What does that need to do going forward to, to boost bank profits, to ensure that they'll be able to carry out their functions and grow as you think they should?
Well, I think, loan growth has been a problem. And obviously they have, this industry has been forced into no new products, no growth, no innovation because of really what happened in 2008. And that's been a problem on the multiples and the problem on the growth. I think when it comes to the yield curve, everybody wants rates to go down. If the Fed starts to lower rates, the banks are going to start to lower the prime. And that's going to take away whatever energy they have on the rise in asset yields to offset the cost of funds. So I think this year, especially through the first half, it's going to be a, push me, pull you on margins. But I think eventually the yield curve will settle out, become positively sloped again, and that's will benefit them. But let's not get too if rates go down as much as the market thinks, was it 4 or 5 moves this year? That's a 1.5%. That means 1.5% off the prime, which will probably hurt just as much as the benefit of the decline in the cost of funds. So I think I would hope that rates would stay near where they are now. Maybe we have 1 cut this year, and that would be better for the banks than having 4 or 5 cuts.
And Dave, I want to get you out of here on this. Listen, we heard from some big banks today, Dave, but we're still waiting. We got Goldman and Morgan Stanley on deck. Did you hear anything today, Dave, which maybe indicates what you might hear from those two when they report?
Well, I think you'll hear pretty much the same stuff. I think, these big banks, what happens to the goose usually happens to the gander. So I think generally you're going to hear kind of the same thing. Maybe it's these, JPMorgan, Goldman's not a bank like JPMorgan, and Morgan Stanley is not a bank like Bank America. So there'll be nuances, but I think the industry's in decent shape. The consumer is showing pretty good resilience. It shows that the economy is reasonably strong. So it tells me that the rest of the earnings out there that we're going to see, meaning non-bank earnings, are going to be probably okay. So it's a good indication of what's happening to the economy. We all know that. And I think they're telling us the economy is in pretty good shape.
Dave, thank you so much for joining us today. Really appreciate that time and insight.
Yep, you're welcome.